Okay, these are the in-class problems for Chapter 7, and we're looking at 4 different in-class problems. One is exercise 7-5. These are all posted on the Moodle site in the same place as the Chapter 6 ones were. It's basically down in the in-class problem solutions area, and so we're posting the video there as well. This problem is problem 7-1. They're monkey around with their financial statements by keeping their cash book open in that case. Here we're looking at problem 7-10. There's a couple of parts. One where once again we're looking at the effect of certain transactions on the current ratio and receivables turnover ratio, and then we are going to look at a number of other transactions and the effect on the current ratio and the receivables turnover ratio, as well as do some interpretation of the results. And then finally, problem 7-15, the cash account shows a ledger balance and the bank statement. That looks a lot like a bank reconciliation, and indeed it is a bank reconciliation that we're going to do there, and we'll make any journal entries that we need to make. So that's where we're going. And the bank reconciliation is part of the appendix in this chapter, but we've already dealt with that in 253, so this is mostly a review. So essentially the bank reconciliation is a review process. So let's begin with 7-5. I would suggest that you open this problem while we're working on it, either by making a screen capture of the video here, or you could open the document from the Moodle site. You can see that here. You can see the Business 353 in Class Chapter 7 solution is here. That's what we're working through. These are the problems themselves, so if you click on that, it'll open the document with the screen captures, including the problems. And then, of course, we're going to put the video in, similar to this one for the Chapter 6 problems that we did before. So let's go back to the problems, and E7-5 is the one we're doing. We're supposed to prepare the entries using the gross method to record sales and cash discounts, and then we'll use the net method to record sales and cash discounts. So once again, we're going to open up a Excel page just to kind of track everything. And here we go. We have our Excel page. We're going to do exercise 7-5. Now, the first transaction, or the first exercise, or the first requirement, is to prepare the entries assuming the gross method is used to record sales and cash discounts. And so this is very similar to some of the lyrics. Labs, I think Lab 7 question number 4 very similar to this. Anyway, the first thing that they did is they sold on July 1st. Oh, I suppose we need to have a place to put the let's go 1 July, and then we'll debit some stuff, and then we'll credit some stuff. So it says we sold $82,000 in computers to Robertson Corp for terms 2% 15, net 30. So what that means is if they pay within 15 days, we give them a 2% discount. If they don't, then the bill is due and payable within 30 days. So $82,000 of sales. Of course, we're going to set up the accounts receivable. No surprise there. That's pretty old hat for us. For $82,000, because we're using the gross method. All right, so let's get ourselves some readable format here. There we go. And of course, then the credit is just going to be to sales revenue, or sales by itself, if you like. Okay, so that's the first entry. And then on the 5th of July, we have another transaction. Robertson Corp returned for full credit 1 computer with an invoice price of $6,200. So we have sales returns and allowances. Doesn't tell us anything about the cost, so we don't really have cost of goods sold entry that we can make here. So I guess if we can't make it, we're not going to, but we're going to record the return, and we want to track that because we want to know whether there's a significant amount of our merchandise being returned to us. And then of course the accounts receivable would go down by the value of that computer that we got back. So it was $6,200 full credit. So we record the sales and returns allowance to recognize the fact that we undid the sales revenue. And of course that's going to be part of the net sales returns and allowances number, which we've seen in earlier chapters. Then July the 10th, we received payment from them for the full amount owed for the July transactions. So that was the 10th of July. And so we would have gotten cash. We would have, well, it's within the 15-day time period, so we're going to give them a discount. And we're going to credit the accounts receivable because they don't owe us any of that money anymore. Okay, and so that's going to be 82,000 minus the 6,200. So the accounts receivable is entirely paid off. Now the discount was 2% of that, so if we take 0.02 times, well, we can take the 75,800 if you like, or we could have just cross-referenced it there. And of course the amount of cash that we get is 75,800 minus the 1516, so 74,284. That's pretty straightforward. Okay, then on the 17th, we sold some more computers. That's when the computer business seems like a good idea. And we sold 160,000 in computers and peripherals to Nawaz store, terms 2% 10 net 30. So this was the 17th of July. Oops, we're going to have to debit something. We are debiting accounts receivable. And I'm betting they're not going to pay within the time frame. So this one is going to be undeserving of the discount. But we've sold more, 160,000 and 160,000. Okay, so that's the same entries we made above. And then of course on the 26th, on the 26th they paid for half of the purchases. So that's kind of a nice little twist. So, whoops, 26. I'm punching the wrong button here. July. There we go. That's what I'm looking for. Okay, I'm stuck in an infinite loop here. Okay, there we go. It says that they paid us half the amount they owed us. And it's 2% 10. It's the 26th, so it's within the time frame. So we're going to get some cash. We're going to have a sales discount because they paid us part of what they owed us, and then we're going to have a credit for accounts receivable. But they didn't pay us all of what they owe us. They only paid us half. So that's 80,000. Alright, so the sales discount in this case is 1%. So, whoops, equals 0.01 times 80,000 is 800. And so the cash we got would be the difference between the two. So 79,200. Pretty straightforward. And then on the 30th they paid us the rest. And of course it's okay. Something's not happening. Go away. Don't need help with this particular problem. I need help with typing, but not with Excel in this function. Okay, so we got cash, and we just got the rest of our accounts receivable. So we got the other 80,000. They didn't send us anything back. Pretty straightforward. So that was exercise 7-5 with the gross method. So Let's just write in here gross. Grass method. Okay. In honor of our impending legalization of marijuana. Maybe we do want to put that in here. So I'm going to, since all of these transactions are going to have the same dates on them, I'm going to just copy them and put them down here. So maybe I need a little more room. So let me pick up a couple of lines here. We'll insert some lines. Not copied cells, but insert some lines. And then we'll put in B. And this is the net method. Okay, so they're exactly the same transactions with exactly the same timing. Okay. So the difference is that under the net method, we assume that they're going to take the discount, and so the net method means that the accounts receivable is going to be after the 2% discount. So we can simply make that 0.98. Another way of calculating the same amount would be equals bracket 1 minus 0.02 times 82,000. So basically we've set up the accounts receivable and the sales revenue as if they were certain of taking the discount, and then when they don't, we record the sales discount forfeited, as opposed to in this case, in the gross method case, when they take the discount, we record that as a sales discount, essentially an expense, a reduction, a contra account to our sales revenue. Alright, so here we go. Then when they sent stuff back, of course, we assumed they were going to take the discount on that, so we're going to have to take out the discount. And we can just copy that and pop it over here. There we go. So the difference between the gross method and the net method for the sales returns and allowances is that we returned it at the lower amount of the sales. Okay, let me see if I can scroll up just a little bit here. So then the amount of cash we get is the same, and the accounts receivable is going to be the 80,360 minus the 6076. So it is 74,284, as you might notice here. The cash received and the accounts receivable reduction are both the same. So essentially we take out the sales discount. There's no sales discount required because we've already assumed they're going to take it, so we'll just delete that whole row. There we go. So that's the entry for the 10th of July. Then we sold some more. The discount is different. For this one, it's a 1% discount. So we take 1 minus 0.01 times the 160,000. Okay, and we can copy that and put it there. Now it says that they paid us half of the amount that they owe us, so half of that. So it's going to equal 0.5 times that, $79,200, and they paid us that within the time frame, so we can see that it's the same amount. So once again, we can just remove that, delete that line, and we don't have to do anything else because they paid us what we expected them to pay us. And then in the last line, or the last journal entry, okay, I'm actually wrong about this one. It's the 30th of August. So let's fix that. I just noticed that it's the 30th of August, not the 30th of July. Alright, so the payment on the 30th of August is far past its 10-day discount period. So the amount of cash we're going to get is 80,000. The amount of cash is not dependent on our accounting method. It's dependent entirely on what the customer has chosen to do, and they've chosen not to take the discount in this case. So the amount of the accounts receivable is going to be the same as this amount, 79,200, because it's just half of the amount that they owe us. So we can just simply take that, and of course we see it doesn't balance by $800, And so I suppose we should calculate that. 80,000 minus 800, or minus 79,200. That is the discount we expected them to take. Of course, it's 1% of 80,000. And we're going to credit an account called Sales Discounts Forfeited in this case. And of course, that recognizes the fact that they didn't take the discount that they were entitled to. And okay, this is great. I've just discovered another thing that it's 2% 10, it's not 1%. So of course that means that I've done both parts wrong. So let's fix them. Under the gross method, that doesn't change, but the amount of the discount does change. It's supposed to be 2%. So there we go. And the amount of cash we get is less than 1,600. Okay, so that's better. And then of course this entry doesn't change because that's the amount of cash we received. Okay, so let's fix this one as well. It is a 2% discount, not a 1% discount. Okay, we did have that. So what am I doing wrong here? Okay, that seems to be right. It's a 2% discount. No, it isn't. It's a 1% discount. I've calculated it incorrectly. So there we go. That's much better. And then we'll just take that one. Okay. So now that I've lost you all, basically the problem that I'm having is if we look back at the problem, I've been using a 1% discount here because apparently I'm interpreting 10 as 1% discount, but it's still a 2% discount, 2% 10 net 30th. So it should be the same percentage. So it should be the same discount rate as here. It should be 2% in both cases. So the amount of the accounts receivable will be less than 2% discount. So once again, we're assuming that they're taking that discount. Then of course the cash amount is going to be different because it's actually a $1,600 discount. So let's go times bracket 1 minus 0.02, and that's interesting. Right, so we different calculation style. Okay, so that's already right. So under the net method, when they pay within the discount period, which they did because 17 to 26 is 9 days, and they had 10 days to make the payment, so they do get their discount. But down here, they don't get their discount because they have forfeited it, and so we need to subtract the correct number here. So that's correct. There's a little note that you'll see in the solution file that says we could have actually made this entry to recognize that the sales discount had been forfeited and adjusted the accounts receivable on the 28th of July, because at that point it was 11 days. So we could have made an entry that looked like this to debit the accounts receivable to increase it for the amount of the increase for the $1,600, and then credit the sales discount. Whoops. Forfeited. What happened there? And then of course when they pay it, the entry at that point would be very similar to this one, except if I just copy that and punch it down here. The amount of cash we get would have been 80,000, but the accounts receivable would have been the 78,400 that we had set up here, plus the discount which we added right here. for a total of 80,000. So that's another alternative. So maybe we'll put a box around this. How's that sound? Put a box around it. Dun, 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 dun. There we go. So this is the alternative form that they're talking about in the note. That would require us keeping track of the dates of the forfeits with a lot of detail, and so that certainly would be acceptable because they've forfeited the discount at the time that we've moved beyond the 27th of July. So there's two alternatives. We could either do this single entry as shown here. Okay, hit the escape button. There we go. As shown here. And so when they pay it, they pay us the full 80,000. And that would probably be the way most companies would do it. But it would certainly be acceptable to record the sales discounts forfeited in this manner. Alright, so that was 7-5. Let's move along then to the next question, which we have here, problem 7-1. And the instructions, first of all, say prepare any entries that you consider necessary to correct their accounts at December 31st. And then to what extent was the corporation able to show a more favorable statement of financial position? We're going to use ratio analysis, presumably the working capital ratio, because we're talking about a bunch of working capital accounts here. Cash, accounts receivable, inventory, accounts payable, and accrued liabilities are all accounts which are part of the current ratio. And so the statement of financial position shown here, these are the accounts that are affected. And then C, discuss the ethical implications of holding the cash book open to show a more favorable statement of financial position. Obviously, if you're not telling the truth to your financial statement users, it can have ethical implications. So let's begin. We have problem 7-1. And part A, journal entries. I suppose you're realizing now that there are lots of journal entries in these intermediate financial accounting courses. So here they are. We're supposed to prepare any entries, easy for me to say. Prepare any entries that you consider necessary to correct their accounts. So the following information is given. They usually close their books on December 31st, but at the end of 2017 it held its cash book open, which means that they basically were recording transactions that happened after the year as if they had happened before the year. And the reason they did that was so that a more favorable statement of financial position could be prepared for credit purposes. So they're going to be lying to the bank, is what I think that implies. Cash receipts and disbursements for the first 10 days of January were recorded as December transactions, and the company uses the gross method to record the cash discounts, and they use a periodic inventory system. Alright, so first of all, January cash receipts were recorded in the December cash book, and they totaled $38,900. So we recorded receipts on our accounts receivable for $38,900. Of that amount, it says $25,300 was for cash sales, and $13,600 was for collections on their 2017 accounts receivable. And of those accounts receivable, $630 of cash discounts were given. So these were recorded as December transactions. We should correct the transactions at the end of the year. So those would have been presumably transactions that were recorded in December, on the December 31st journal entry. And so we need to undo them. We need to set up the accounts receivable for the amount that has been shown as collected. We are going to reduce our cash because we didn't actually receive it by the end of the year. And the cash sales, of course, would be sales revenue. Let's type some things in here. We're going to debit our accounts receivable because it shows collections of $13,600 on 2017 accounts receivable, for which cash discounts of $630 were given. So the collections were $13,600. Let's go over here, and I think that's let's just pop up here. Okay, I and J, that works. So I has the right formatting, so that's good. All right, so the accounts receivable that we should record would be the $13,600 which was collected, plus the $630 which for which cash discounts were given. So $14,230 is the amount of accounts receivable that were outstanding at the end of the year. Then we have sales revenue. We could call it cash sales if you like. But the sales revenue was January sales revenue, and so that was $25,300. And they tell us that the cash receipts were recorded for $38,900. So the cash goes back out because we didn't have it. And finally, we have the sales discounts. That we erroneously put into this year for $630. So the sales discounts weren't earned until the January cash receipts were received. And so as a result, we're going to undo all of those. So that's the first entry. That's essentially to correct the cash receipts. We also had some January cash disbursements in paragraph 2 of the information. It says January's cash disbursements that were recorded in the December check register were for payments relating to $24,850 of accounts receivable on which discounts, purchase discounts in this case, 520 were taken. So, the same day, we can put it in again if you like. We're going to debit some things. Accounts payable comes to mind, because we need to make the accounts payable go down, of course. And the accounts payable was $24,850. And oops, I'm wrong about that. It says that we had recorded them as being paid, so we've already recorded the entry showing them as being paid. So that means that we've got cash that has been recorded as going out. So how much cash actually went out? $24,850, but we took some purchase discounts, so we didn't actually pay that much. We paid the reduced amount of $24,330. And then, of course, we recorded some purchase discounts, and purchases are recorded as debits, so purchase discounts, of course, are the opposite direction. So to undo them, we need to debit them. Purchase discounts was for $520. And then the credit would be to accounts payable, because they were still outstanding at the end of the year, so we should have that liability still outstanding, and that should be $24,850. And that should be the total of these two. And as I said before, you can check that with Excel if you highlight them. Look way down here at the bottom, and once again the red line's in the way. Right down there, you can see that the sum, the average, the count, and the sum are shown at the bottom. You can change that if you want, if you click, right click, I think. Well, we'll just leave it. I'll let you learn that on your own, but it's kind of a useful little summary thing at the bottom of the Excel spreadsheet. Okay, so those are the journal entries that we should have made to correct their two transactions. Number 3 paragraph says the general ledger has not been closed for 2017, so that means that we can go back and fix it by making a journal entry now. And the amount shown as inventory was determined by a physical count on December 31st, 2017. So the inventory is presumably the correct amount. We don't have any costs to go with any of these revenue transactions. Of course, if we had them, of course, we would have to undo those cost transactions as well. But there's no cost information, so it says we're using a periodic inventory system. I suppose that would be why. So we counted the inventory and calculated the cost of goods sold. So we actually recorded cost of goods sold, presumably, for the correct amount of inventory. So the sales revenue, like this sales revenue, the cash sales after the end of the year would not have had the cost of goods sold recorded against them, which of course makes your revenue look better and your cost of goods sold is reduced. So that makes your income statement look better. All right, so that was A. B, we're supposed to be looking at to what extent was Dev Equipment Corp able to show a more favorable statement of financial position at December 31st by holding its cash book open. Use ratio analysis. So let's calculate the current ratio, also known as the working capital ratio. And it's basically current assets, not current assets, spelled that way. Those would be small Corinthian raisins, divided by current liabilities. Okay, let's make a fraction by popping up here, and we're going to put a bottom border. There we go. So the current assets, as shown on our question, our current assets are 39 plus 42 plus 67. So that's the current assets, and these are after the erroneous entries have been made. And so 45,000 and 14,200 would be the amount of the liabilities. So if we add those up, we can an equal sign there. There we go. Okay. Stop. Don't do that. Just an equal sign. Enter. There we go. So the current assets, we add them all up. Works out to 39,000 plus 42,000 plus 67,000. And that will be divided by current liabilities, which are 45,000 plus 14,200. And again, we can pop in a fraction. So the ratio of those is going to simply be that divided by that. And we're going to need a couple more decimals, so we just go up here and pull up the decimals a little bit more. So this is as stated, and then as corrected. Okay. And let's just copy all of this out, because we're just going to adjust those calculations. So here we go. Now the current assets, if we look up here, current assets go down for accounts receivable. Oh, sorry, I'm wrong. I'm lying to you. We're going to increase for accounts receivable and decrease for cash. So if we go here, let's increase for accounts receivable 14230, and then we're going to subtract the amount of cash. But we also have cash being adjusted in the second transaction, so it'll be different by 24,330. Okay. We're not quite done because we also have some adjustments on the liability side. Our accounts payable went up by 24,850. And so that results in a current ratio of 1.76. So it went from 2.5, which is quite good, to a 1.76 ratio. So of course that's going in the bad direction, since it says that we are preparing these financial statements for the purposes of for credit purposes. The more favorable statement of financial position could be prepared for credit purposes. And of course, as a creditor, you would view a $2.5 times current ratio as being quite a bit better than a 1.76 times credit ratio or current ratio. So it's clear that they are trying to fool the creditors. So what does this tell us? What C asks us to discuss the ethical implications of holding the cash book open. Well, the implications of the cash book open might be expressed in the fool me once, shame on you, fool me twice, shame on me expression, in that you would probably only get away with this once. If they found out about your manipulation of the financial statements to make them look better for credit purposes, then you're basically telling them things which are not true about your credit worthiness, and so they're going to be giving you a loan on the basis of incorrect information. And if it's a loan based on incorrect information, that means it's going to be mispriced. They'll be undercharging you for interest, and they won't be adequately compensated for the risk that they're taking. So if it gets found out, you will have a worse reputation with creditors. It might well affect your future credit, not only with this company, but with other related companies. You might be sued. So if you're sued, then of course it becomes public knowledge that you were lying on your financial statements, and you may even have to go. You may even go to jail. Not really sure. That doesn't seem to happen a lot for white-collar crime, but it is certainly a possibility that there could be you could be prosecuted for fraud. So you definitely don't want to do this sort of thing. Anyway, that's problem 7-1. It's completed. So let's move along. Problem 7-10 is next. So here we go with problem 7-10. It's a situation where we have some notes receivable, and we need to determine, first of all, journal entries, and then the effect on the current ratio and the receivables turnover ratio for the year. And then in part 2, we're assuming some additional transactions at the end of the year, one of which represents the sale of a note receivable, and the other of which represents the factoring of some accounts receivable at the end of the year. So let's begin with part 1. Alright, so here we have problem 7-10, part 1. And, ooh, I'm losing my problem. Okay. So, part 1. We have a number of pieces of summary information. And it says the total sales were $465,000. We're supposed to be preparing summary journal entries to record these items. So, total sales were $465,000, and of that total, the oops, trying to move my problems so I can actually see them while I'm talking to you here. The total sales were $465,000, and of that total sales amount, $215,000 was on a credit basis. So that tells us that it was accounts receivable. So we're supposed to prepare the journal entry to record those. So during the year, don't actually have a date for them. So we're going to get cash, and we are okay. So total sales revenue. We can put sales revenue in. Can figure that one out. Okay, it's always a good idea to figure out which of them is the easiest to record. So we know $465,000 was the total sales revenue, of which $215,000 was for cash. So the rest of it presumably was for accounts receivable. That's a lot of C's in there. So we'll just calculate that minus that. $250,000. I think I've interpreted them backwards. It says that $215,000 is on the credit basis. So it's actually the accounts receivable that's the $215,000, and the $250 is cash. Okay, so that's the first entry. Then the paragraph 2 of the information tells us that on June 30th, a $50,000 account receivable of a major customer was settled, with Logo accepting a $50,000 1-year 11% note with the interest payable at maturity. So they're going to pay us their note receivable 1 year from now, 1 year from June 30th. So we could actually put a date for that one. 30 space June. Oh boy, I don't want to keep doing this. Let's try 30 June. There we go. Okay. So we're going to debit a note receivable and credit the accounts receivable which went away. And that was for $50,000. 50,000 of receivables gone, 50,000 note set up. So we don't have any accrued interest or anything like that at this point because it's June the 30th, and our year end is presumably the 31st of 2017, December 2017. Alright, so then those are the first two entries. We have another entry, number 3, collected $160,000 on accounts receivable during the year. So not really a date for that either, but we debit, cash. Oh man, if I could type, that would be good. Okay, I can't even complain about the keyboard because I'm actually typing on my own keyboard. Accounts receivable. So a little bit of a challenge to talk and type at the same time. Somewhat akin to chewing gum and walking at the same time. Alright, so we collected $160,000 on our accounts receivable. That's good. So we sold $215,000 and collected $160,000 of that. That's good. On December the 31st, 2017, they had a balance in their cash account of $15,000. Inventory had a balance of $80,000. Accounts payable is $70,000, and accrued liabilities are $16,000. And of course, those are all different from the numbers shown at the previous year, but we don't have to make adjustments for those, presumably. But we do have to record the fact that we've got a note, that one up there, June 30th. That note includes interest, and so we need to record the interest receivable. At the end of the year, and then we're going to credit interest income in Coleman, and we're going to do a calculation here. We could do that. It's 50,000 times 1%, 11% times 6 months out of the full 12 years. 12 years, boy. $50,000 is the amount of the note. 11% is the interest rate. It's been outstanding for half a year. So we couldn't actually type that in. We'd have to type it in a different way. Times 0.11 times 6 divided by 12. There we go. And we can copy that and put it over here. There we go. So those are the journal entries that we were supposed to record. And it says to calculate the current ratio and the receivables turnover ratio for Logo at December 31st, 2017, and use these measures to assess Logo's liquidity. The turnover ratio last year was 4.75. So, let's just pop up here and steal this one. And then we'll pop it in down here. Of course, we have different numbers. So our current assets include cash with a balance of $15,000. need an equal sign. This is not lyrics, but rather Excel. Inventory, 80,000. Accounts payable, 70,000, and accrued liabilities are 16,000. Okay. So our accounts receivable, 15 plus 45. Oh, plus we have the interest receivable, and we also have the note receivable, which is due in 6 months. Is that everything? We have 15. We have 80,000. We have 2750 and 50,000. Okay. $15,000 cash. Inventory, 80,000. Accounts payable. Our accounts receivable is going to be presumably the 215,000 minus the 160,000. So that would be what, $45,000? So that's our total current assets. Our current liabilities are going to be the numbers given to us. So 70,000 plus 16,000. All right, so that works out to 2.36. Okay, that's not quite the number I'm looking for here. We have 15,000 for cash. We have 80,000 for the inventory. We have 2750 for interest receivable. We have 50,000 for the note receivable, and we have accounts receivable of 45,000. 215, 160. Okay. For some reason that's not giving us the correct, not the same number as the for some reason this is different from the calculation that that is shown in the solution. It's $2.24 is the solution value, and we get 2.36, which is strange. All right, so 1545 is 60, 110, 190, 192, 750. Do we have? Okay, 15 plus 45 is 60, plus 50 is 110, plus 80 is 190, plus 2750 is 192, 750, and we've got 202, 750. So do I have a typo here somewhere? 15 plus 80, 215 minus 160 is 55, not 45. Seems to me that they've made a mistake, because they've got accounts receivable shown as 45,000, and it should actually be 55,000. It's 215 minus 60, which is 55,000. So I think that's actually a typo in the solution. So I think we're right, they're wrong. It also said that well, let's do the same calculation for this is 2017, and we should do the same calculation for 2016. So 2016, we're given all of these pieces of information. So the cash is 20,000, plus we have accounts receivable of 40,000, plus we have inventory of 85,000, and that is over accounts payable of 65,000 plus 15,000 for accrued liabilities. So that works out to 1.81. Yeah, that's the same as they had. We need to calculate the 2017 accounts receivable turnover. ARTO. And so for that, we want credit sales. I think we'll do the same as we did up here. Just take those. And we'll rename them. There we go. Let's go credit sales over average accounts receivable. Our credit sales, we can see up here, 215,000. That's easy enough. And the average accounts receivable, we started with 40,000, and we now have, well, let me see, 40 equals 40,000 divided by 2 plus 215,000, whoops, minus 160,000. Yeah. Okay. We should also include the note according to, yeah, that's 55,000. Our note is for 50,000. I think they're also doing a typo there. They're recording it as the wrong number as well. The 215 minus 160, pretty sure that's 55,000. Plus we have a $50,000 note. And of course that gets weighted by half as well. So that works out to 72,500. That's 2.97. Their solutions shows 3.19 times, but I think they've underestimated or understated the accounts receivable. We started with 40, we added 215, and we subtracted 160. No, that doesn't explain it either. I'm not quite sure where they're coming up with their number. And it says that the 2016 number for turnover was 4.75. Oh, okay. We need more, a bit more. There we go. Okay. So then the next question is, well, it says calculate them and then use these measures to assess their liquidity. So is it getting better or getting worse? In 2017, the current ratio is better because it's 2.36 versus 1.81 the previous year. So that's good. Accounts receivable turnover is much slower than it was the previous year. And what does that say about liquidity? Well, we can pay our bills more frequently or more times. So we've got well more than enough to pay our current liabilities 2 times over, whereas last year was a little under 2 times. The accounts receivable turnover is how quickly you're actually collecting your accounts receivable. And of course, one of the accounts receivable, $50,000 just became a note receivable of $50,000, and instead of being collected in this normal, usually 30-day turnaround, something like that, the note receivable is a 1-year note receivable. So that is really affecting the turnover fairly substantially. So it's reducing it substantially. So if we didn't have that in there, so let's just take out, where are we here? The accounts receivable. If we didn't have the $40,000 note, $50,000 note, the rate would be 4.53. So if we collected that on time, it wouldn't be that much different from our previous result. Okay, so that was part A. Everybody good with part A? Let's move on to part B, or part 2. This, of course, all of these calculations are B. So it's part 2. We're going to move along. And part 2 Part 2 says, now assume that at the year end of 2017, Logo enters into the following transactions relating to the company's accounts receivable. So first of all, they sold the note receivable, the $50,000 note receivable, to Prairie Bank. And then to the second transaction, they factored some accounts receivable. So our first bit of instructions for part C of the entire question. Okay, and there we go. Undo that one more time. Here we go. Prepare the journal entry to record the transfer of the note. And then D. Prepare the journal entry to record the sale of receivables. And then calculate current ratio, receivables turnover ratio, and assess the liquidity. Remembering that receivables turnover last year was 4.75. And then discuss how the ratio analysis in part E would be affected if Logo had transferred the receivables and secured borrowing transactions. Secured borrowing means that we keep the receivables, they don't go away, and we also have a long-term liability. Well, not necessarily long-term, could be short-term liability, but a note payable that goes with the accounts receivable. So, first transaction, it says that they sold at the okay, this is at the 31st of December, so we can start with that. And we sold the notes receivable, so presumably the notes receivable is going away. Okay, and that was for $50,000. So it's gone. We got some cash because they sold the note receivable for $50,000 in cash, plus accrued interest. So the cash is going to be 50,000 times 1 plus, oops, I need to do a times, can't just stick the bracket in there, 1 plus 0.11 times Excel times, please, 0.11 times 6 over 12, because we issued it at June 30th. Okay, we found a typo. Oh! No doubt. Don't accept the correction. Let's fix it. I'm going to fix it. Okay. Okay. Excel mind. Shortcoming, I guess. All right, so we got 52,750. Our note receivable went away, and presumably the interest receivable also goes away, which we calculated above as being 2750. Okay. Now right there it looks like it's balanced, but that tells us more. Given the credit worthiness of Logo's customer, the bank accepts the note without recourse and assesses a finance charge of 3.5%. So they're not going to give us the 52,750, they're going to give us a little bit less. So there's a finance charge. We could call it a finance charge or service charge expense or something like that. The solution calls it a loss on sale of receivables, which I suppose is as good as any title. Losses and expenses are essentially treated the same under IFRS, so we're generally okay with that. It doesn't really matter what we call it as long as it's a descriptive title. And of course that is 3.5% of the note. So that is equals 0.035 times the 50,000 plus the 2750. Now you could interpret the language in the note to say that it accepted the note without recourse and assessed a finance charge of 3.5%. You could assume that the 3.5% was only for the 50,000, but they are bankers, so good chance that they're going to actually charge us a little more for the accrued interest that they're accepting as well. So they paid us for the accrued interest, and of course we're going to subtract the finance charge. So 50,904 was the actual amount of cash that we got as a result of this transaction. Okay, so that's that transaction. Then the next one, logo factors some accounts receivable, also on the 31st of December. So we got some cash there as well. Here we've got accounts receivable going away because they're actually being sold without with recourse. Okay, let's read the description exactly. It says logo factors some accounts receivable at the end of the year. Accounts totaling $40,000 are transferred to Primary Factors Inc. with recourse. So the accounts receivable goes down by $40,000. It says with recourse, so that means that if they don't pay, then logo is going to have to come up with scratch. And so it tells us that the fair value of the recourse obligation is $4,000. That's essentially a liability. So we have a recourse liability, just like we had in previous examples, the last chapter I believe it was. It's essentially an unearned revenue amount, $4,000. So if they don't actually, no, this one isn't really an unearned revenue amount. This is a promise to pay if they don't get paid. So it's kind of bad debts, I don't know, insurance, something like that. But we presumably are going to have to pay recourse liability. Of course, that's essentially an expense. Okay, so primary factors retain 6% of the balances and assesses a finance charge of 4% on the transfer. So I think I need to put in another line here, please. Insert another line. I need another debit. So I'm going to recognize the fact that the primary factors retains 6% of the balances. So that is due from the factor. That's money that they will pay us. If they collect everything without any trouble, they'll owe us that money. And so they're basically holding on to part of the accounts receivable, and they're going to pay us the okay, where am I going with this? This is the 6%. So let me put that into the description here, just so we know that that's the 6%. Retained. And then we also have the 4% finance charge, which is a loss on sale of receivables. So it's going to be which equals 0.04 times that, or 1600. Okay. Now how much cash do we get? The loss on the receipt. Okay, so that would be included. The finance charge would definitely be a loss. There's also the recourse liability, so we need to include that as well, because we're on the hook for that. So if they don't collect it, we're going to have to pay them ourselves, which means we owe them the money, which reduces the value of the receivables for us. So let's see what that works out in terms of cash. We should have 40,000. Well, it's a balancing figure. It's the amount of cash we get. So we get 40,000 minus the minus the 2,400, because that's they're not going to pay us for that until later. So they're basically holding it aside. It's a holdback, and if they don't collect them all, they'll keep the 2,400 and use it to offset it. And then of course we also have the fee, which was 1,600. cash was calculated as 0.04 times 40,000. That should still work. Okay, 36,000 is the amount of cash we get. So once again, let's just quickly take a look at that. It's the 40,000 of accounts receivable minus the 2,400, which is retained by the factor. So they didn't actually pay us that. Alright, so that's C and D. The next part is to calculate the current ratio and the receivables turnover ratio. So once again, we need to go up here. So let's grab all of those and copy and pull them down here. I think that's how it works. Okay, then we have, alright, oops, alright, oh, no, don't do that. And undo that. Well, why can't you just, okay, let's go. I don't know if that'll work. No, it likes euros. I don't know why it likes the euro so much. But that's supposed to be an E. Alright, so here we go. Let's calculate our current ratio. So we have the numbers from before, the 15,000 plus our 50,904 is the cash we've got. Okay, let's go here. 15,000 was the amount that they gave us for the balance in cash before these entries. So we added 50,904 and we added 36,000 for cash, and then we have $5,000 from what? It says we have $5,000. Where's the $5,000 coming from? Don't know what the 5,000 is, but we have we do have inventory of 80,000, and we have the factor owes us 2,400. Oh, I know where they got the 5,000. Alright, they actually have it wrong again. So we added 215,000 of new sales, and we subtracted 160,000 of collections, and then we factored 40,000 of those. And that should be the numerator. The denominator will be the liabilities. So we have accounts payable of 70,000 and the accrued liabilities of 16,000. Plus we have another 4,000 of recourse liability shown here. So this due from factor, that's a current asset. And this recourse liability is a current liability. Alright, so our new well, they get 2.1, but that's because they are missing $10,000 of this collection between the 215 and the 160. 215 was our total accounts receivable during the year, and our 160 is what the collection was. Alright, so then down to credit sales, 215,000. Our average accounts receivable now was 40,000 last year, and now it's whoops, we need to subtract, whoops, subtract 40,000. subtract usually with a negative, a minus sign. 27,500, which is pretty good, 7.82. So the next question is discuss the use these measures to assess their liquidity. So after we do these calculations, we have 2.21 is our current ratio versus 1.81, which is better, and 7.82 versus 4.75. So we've speeded up the collection quite a bit. We were planning to take another 6 months yet to collect the note receivable. It took us 6 months to collect it already, so that helped things substantially. F, it says discuss how the ratio analysis would be affected if they had transferred the receivables in secured borrowing transactions. So let's put that here. With secured borrowing, the receivables basically stay on the books, so we would still have the note receivable, we still have the accounts receivable, and we would record a note payable that was payable on the basis of the borrowing. But of course it would still increase the cash, so the cash would go up, but the receivables would stay on the books. So we'd have a receivable and a note payable presumably offsetting each other for each of them, so the net effect on the current assets would still be this. Well, the current assets would be higher, the current liabilities would also be higher. The effect of on the current assets, because the current assets are larger than the current liabilities, would actually decrease. I think it would actually have a slightly lower current ratio, and the receivable turnover ratio is only based on the accounts receivable. That would presumably stay the same, so we wouldn't have any increase in accounts receivable. Finally, from Prairie Bank's perspective, what is the total effect on its net income as a result of purchasing the note receivable without recourse? Prairie Bank now has, they've bought something that's worth $55,000 to them, which is they're going to get $55,000 because there's a $5,500 interest receivable that they're going to have. Like, there's the 11% is going to be paid when they collect the note receivable, so they're going to be collecting $55,500. So they collect $55,500, and they paid us $50,904. So they made $45.96 as the profit on this operation. But of course the note is without recourse, so if they don't collect from our note, the major customer with whom we settled, if they aren't able to collect, then they of course are subject to the losses. And then finally G. The question is from primary factors perspective, what's the total effect on its net income as a result of purchasing the accounts receivable with recourse? Well, it's going to collect presumably some portion of the $40,000 by themselves, and whatever they don't collect, excuse me, the logo is on the hook for. So they're actually going to collect the $40,000 plus they're going to get the $1,600 fee. I guess I needed some kind of sign up front there. A typo. 1,600. Oh, they didn't like the comma. One moment, please. Okay, I think I'm back, and I think I'm okay. So they're going to collect the $40,000 plus the $1,600. Whatever they don't collect from the customers, they will be collecting from Logo. So they don't have any problems with that. And in terms of the cost, well, they're paying us the $36,000, and presumably that's all they are expecting to pay, because the $4,000 recourse liability will be recovered from Logo if they aren't paid out, and if they actually do collect 100%, then they'll be giving us another $2,400 for the due from factor. and just keeping the $1,600 fee. So presumably they're keeping the $41,600, and they will have to pay. Well, they haven't paid it all yet, but they're going to pay us the $36,000 they've already paid us, plus they presumably have to pay us the $2,400 in the due from factor. And so once again, their net effect is they get $41,000 and they pay $38,400. Okay, my video has gotten a little long here, so it's an hour and 15 minutes so far, so I'm gonna shut it off there and pick up a new one for the last question, but I'll post 2 videos to YouTube, and the first one will be an hour and 16 minutes, and the last one will be hopefully much less than that, to do a bank reconciliation. So thanks for listening.